Hello intelligent investors, this is Victor here. If you have been following MasterCard stock this year, you will know that MasterCard stock is now near its 52 weeks low. The stock has dropped as much as 18% from its peak in the past 12 months. The main reason is that investors are still concerned about potential lockdowns and new COVID variants that are still affecting many countries around the world. Many investors are concerned that international travel, which affects MasterCard's cross-border transaction revenues, will not return to the pre-pandemic level until 2023. In this video, I'm going to analyze MasterCard stock to see if it's a great company for long-term investing. I will show you how to calculate MasterCard's fair intrinsic value, so you know whether MasterCard is undervalued, fairly valued, or still overvalued. I will cover these topics in this video. First, how does MasterCard make money? You will learn about MasterCard's business model and its biggest competitive advantage. Second, MasterCard's biggest long-term growth catalysts. Third, MasterCard's three major risks you must know. Fourth, MasterCard stock valuation. And fifth, will I buy MasterCard stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos a week that will help you become a great investor. The link is in the video description. Take a look, let's start. What is MasterCard's business model and how does MasterCard make money? If you use credit cards a lot, you will know that Visa and MasterCard are the two most popular credit card brands in the world. Contrary to the popular belief that MasterCard is a credit card company, MasterCard actually does not issue you credit cards, debit cards, or prepaid cards. MasterCard does not give you credit when you sign up for a MasterCard at a local bank. It is your bank that gives you the credit and issue you a MasterCard credit or debit card. This means it is the banks that will carry the credit risk, not MasterCard, if customers cannot pay off their credit cards. MasterCard is actually a payment card network. MasterCard processes transactions when customers and businesses use MasterCard branded cards to buy things online and offline at retail stores. This is from MasterCard's latest annual report. MasterCard operates a multi-rail network that offers customers one partner to turn to for their domestic and cross-border payment needs. Through our unique and proprietary global payments network, which we refer to as our core network, we switch, authorize, clear, and settle payment transactions and deliver related products and services. We also provide integrated value-added offerings such as cyber and intelligence products, information and analytics services, consulting, loyalty and reward programs, processing, and open banking. If you look at MasterCard's financial here, you can see all MasterCard's revenue sources, including domestic assessments, cross-border volume fees, transaction processing, and other revenues. All these revenue sources are driven by the number of transactions that are processed through the MasterCard network and the gross dollar volume (GDV) that is processed through the MasterCard network. This means the more payments MasterCard network processes, the more money MasterCard will earn. Outside of China, the payment card network industry is a duopoly between Visa and MasterCard. Visa is the largest payment card network in the world, and MasterCard is the second largest payment card network in the world. We are excluding UnionPay because UnionPay is mainly in China and the Asia Pacific. For example, in 2020, Visa had a global market share of 40% and MasterCard had a market share of 24%. In the US, Visa had a market share of 52% and MasterCard had a market share of 22%. Similar to Visa, MasterCard's biggest competitive advantage is its network effect. Millions of consumers and businesses around the world already use MasterCard debit and credit cards. 80 million merchants around the world already accept MasterCard for payments. MasterCard works with more than 20,000 financial institutions around the world to issue MasterCard payment cards and to use MasterCard's payment network. It's almost impossible for merchants not to accept MasterCard because many consumers and businesses use MasterCard to buy things online and offline in retail stores if they don't want to use cash. If a merchant does not accept MasterCard, the merchant will lose a lot of sales. This is what we call the network effect. I believe this is MasterCard's biggest competitive advantage and economic moat. So how does MasterCard make money if it does not issue credit or debit cards? In a typical transaction, there are 4 parties involved. You as the cardholder, the issuer bank that issued the credit or debit card, the merchant, and the acquired bank that works with the merchant. The MasterCard network connects all 4 parties together to process transactions. MasterCard is responsible for switching, which is authorizing, clearing, and settling transactions. According to this article here, whenever MasterCard processes a payment, the banks will pay a fee per transaction, i.e. switch transaction fee, and a percentage of the gross dollar volume, i.e. switch volume fee, to the network provider. Let's say you are spending $100 to buy groceries at Walmart. Walmart does not receive the entire $100. Instead, Walmart will receive $98. This is because the issuer bank that issued the credit card will keep $1.52 of the interchange fee. The interchange fee is always the highest fee in a typical transaction. The acquired bank that works with the merchant, or Walmart in this case, will keep 48 cents. MasterCard will receive 2 cents of network fee from the banks for processing this transaction. Walmart would receive $98 and pay $2 of merchant discount fee in total. According to Investopedia, most merchants can expect to pay a 1% to 3% fee for payment processing of each transaction. 2 cents of network fee is not a lot compared with the much higher interchange fee, but these network fees can add up very quickly because MasterCard processes billions of payment volume every day. For example, MasterCard has processed 5.6 trillion of gross dollar volume year to date as of Q3 2021. This means MasterCard can earn a lot of revenue and net profit every quarter as long as MasterCard continues to have high gross dollar volume, GDV, high cross-border volume, and high switch transactions every quarter. Switch transactions are the number of transactions that are processed through the MasterCard network. These are the 3 most important metrics that drive MasterCard's revenue growth every quarter. It is important to follow these 3 metrics if you want to know whether MasterCard's business is growing or if it's still impacted by the pandemic. For example, in the recent Q3 quarter, MasterCard's gross dollar volume was up 20%, cross-border volume was up 52%, and switch transactions were up 25%. This is a good sign because it shows MasterCard's business is already recovering from the pandemic. In terms of financials, MasterCard had very consistent revenue growth, operating income growth, operating cash flow growth, and free cash flow growth before the pandemic in 2020. Obviously, MasterCard's business was impacted by the pandemic in 2020. However, you can see MasterCard's trailing 12 months of revenue and trailing 12 months of operating cash flow have already recovered. MasterCard has a high operating margin. It had a year-to-date operating margin of 53.1% as of Q3 2021. During the same period, MasterCard had 6.92 billion of cash equivalents. This is down from 10.6 billion of cash equivalents in 2020, mainly because MasterCard used 4 billion of cash to acquire businesses during the period. MasterCard has been buying back shares almost every quarter for many years. This is good for long-term shareholders. When it comes to investing, we have to be forward-looking. So let's talk about MasterCard's biggest long-term growth catalyst before we talk about MasterCard's biggest risk you must know. I believe MasterCard's biggest growth catalyst in the short term is that its cross-border transaction revenue is recovering because more countries around the world are opening their borders and allowing international traveling again. I mentioned this earlier. MasterCard earns revenues based on the number of transactions and gross dollar volume that are processed through MasterCard's payment network. MasterCard earns more revenues from cross-border transactions because of currency exchange fees. If you look at this here, in the most recent month, you can see MasterCard switch volume, switch transactions, and overall cross-border volume have already recovered compared with its 2019 levels. Only MasterCard's other cross-border volume is not fully recovered yet from its 2019 level. But you can see cross-border volume has increased from Q3 to October 2021. This is a good sign. In my opinion, I believe it will just be a matter of time before international travel returns to the 2019 level again. When countries, especially European and Asia-Pacific countries, lift their COVID restrictions and ease cross-border traveling again, consumers will travel much more and spend using their MasterCard in other countries. Management said this: Q3 net revenues are now 11% above pre-COVID levels in 2019. We're seeing continued strength in domestic spending, and overall cross-border volumes are now back at 2019 levels, though there still remains significant room for growth in cross-border travel. And we're encouraged by the recent resurgence in international travel. We're optimistic about the announced relaxation of border restrictions in places like the US and the UK, given that we have seen travel pick up when borders have opened in the past. Further, the airlines have recently reported increased travel bookings, including long-haul travel. With this as context, assuming domestic and cross-border spending trends relative to 2019 continue to improve, we will expect Q4 net revenues to grow at a low 20s rate year over year on a currency-neutral basis, excluding acquisitions. Of course, if there are more COVID variants such as the new COVID variant discovered in South Africa, there will be more potential lockdowns and travel bans, which will impact MasterCard's cross-border transaction revenues. You will want to know this: MasterCard's biggest competitor, Visa, expects cross-border travel will not return to 100% of the pre-COVID level until the summer of 2023. In comparison, MasterCard is more optimistic than Visa. According to the recent MasterCard Investor Day event, MasterCard expects cross-border travel will return to 2019 levels by the end of 2022. MasterCard also gave this guidance for the next 3 years between 2022 and 2024. MasterCard expects its net revenue compound annual growth rate CAGR to be in the high teens, its operating margin to be a minimum 50%, which is a very high operating margin, and its earnings per share to be in the low 20s. Again, this assumes cross-border travel will return to 2019 levels by the end of 2022. In comparison, MasterCard's net revenue grew at a compound annual growth rate CAGR of 17% between 2017 and 2019. I believe cross-border traveling will eventually return to normal either in 2022 or 2023. When this happens, MasterCard's cross-border transaction revenues will be higher than the current level. I believe MasterCard's biggest growth catalyst for the long term is that more consumers are moving away from cash payments and are using cashless electronic payments much more than before. The pandemic that started in 2020 has accelerated the transition from cash payments to electronic payments. This actually benefits MasterCard because MasterCard is the second most popular payment card brand in the world, behind Visa. I mentioned this earlier, many consumers already use MasterCard to buy things online and offline at retail stores. Most merchants already accept MasterCard for payments. MasterCard partners with thousands of issuer banks around the world to issue MasterCard branded cards. MasterCard also partners with many merchant banks around the world to use MasterCard's payment network. Banks will want to continue promoting MasterCard because they can earn interchange fees and merchant discount fees from merchants. All these things combined, in my opinion, create a huge network effect for MasterCard. If a merchant decides not to accept MasterCard, the merchant will lose a lot of sales. Visa also has the same network effect. Mobile contactless payment is becoming very popular now because it's much more convenient than carrying cards and cash. It's also very secure. For example, if you're an iPhone user, you can use your Apple Wallet that has your MasterCard to buy things in retail stores. If you're an Android user, you can use Google Pay, that's your MasterCard, to buy things in retail stores. In my opinion, I believe mobile contactless payments and card payments will eventually replace most cash payments. Buy now, pay later has become a very popular payment option in recent years because consumers can split their payments into several installments to help them manage their finances better. These installment payments are usually interest-free. MasterCard recently introduced its Buy Now Pay Later program in the US, Australia, and UK. This is still in the very early growth stage. I believe the next biggest growth opportunity for MasterCard is crypto-linked MasterCard. As of now, MasterCard is partnering with many cryptocurrency companies and platforms around the world to create crypto-linked MasterCard. This will allow consumers to instantly convert their cryptocurrencies to fiat currencies and to shop in any stores online and offline that already accept MasterCard. Going forward, I believe there will be many more crypto-linked MasterCard that will offer Bitcoin and other popular cryptocurrencies as rewards. I believe this will be another growth catalyst for MasterCard going forward. Let's talk about MasterCard's biggest risk you should know about. I believe MasterCard's biggest short-term risk is COVID lockdown around the world, especially in Europe and the Asia Pacific. As of now, many countries are gradually opening their borders and allowing international traveling again. However, if there are more COVID variants, such as the new COVID variant discovered in South Africa, there will be more lockdowns around the world and cross-border travels will be more restricted. Management said this in the recent earnings call. The one area which I would say is still a little bit kind of yet to be seen is Asia Pacific, right? In Asia Pacific, recovery in cross-border has still been kind of somewhat muted. Asia Pacific, which is one of MasterCard's biggest markets, is still restricting cross-border travel. If the pandemic continues to be longer than expected, and if there are more COVID variants, MasterCard's cross-border transaction variants will be impacted the most. I believe MasterCard's second biggest risk is interchange fee regulation, which also applies to Visa. As of now, MasterCard and Visa set the interchange fee, also known as swipe fee, paid by merchants when consumers swipe their cards to buy things online or offline at a retail store. MasterCard's interchange fee is typically around 2% plus a fixed fee, depending on the type of transaction. Most merchants, including the largest online retailer, Amazon, believe these interchange fees are too expensive, especially for credit card payments. Amazon is planning to stop accepting UK issued Visa credit cards starting in January 2022, mainly because Amazon believes Visa's interchange fee is too high. The Visa ban actually benefits MasterCard. In the past, the European Commission had fined MasterCard 570 million euros over anti-competitive behaviors. The antitrust regulator alleged that MasterCard was forcing merchants to pay higher payment processing fees by limiting merchants to only use banks in their home countries for payment processing, instead of letting merchants use banks with lower processing fees in other European countries. The interchange fee is the largest payment processing fee. Going forward, if regulators find that MasterCard's interchange fees are too high, or find that MasterCard is practicing anti-competitive behaviors, regulators will likely limit MasterCard's interchange fees and impose fines on MasterCard again. I believe MasterCard's third biggest risk is the increasing adoption of account-to-account A2A payments in Europe. This account-to-account payment network helps merchants reduce payment processing fees by skipping the middleman, which is MasterCard and Visa's payment networks. According to this website, A2A, account-to-account payments, are similar to P2P payments. Essentially, A2A payments involve the transfer of funds from one customer's account to another account at either the same financial institution or another one. This is done through ACH or ATM networks. A2A moves directly from consumers to a merchant bank account with no go-between. Overall, they reduce friction and delivery at a much lower cost due to their efficiency. However, through open banking and real-time payments, A2A has a genuine opportunity to become a credible rival to the card payment rail for everyday transactions. What has changed is open banking and APIs. Now, there's the potential for open banking payments to reach anyone with a bank account in a truly efficient way. Open banking has helped A2A payments achieve greater reach. All this means is that open banking and account-to-account payments have the potential of disrupting MasterCard's payment network and helping merchants reduce the payment processing fees they have to pay to their merchant banks. Management said this: "We have account-to-account technology really since the acquisition of VocaLink. So what we believe is this should be something that is built into our network, into our multi-rail capabilities, and it's actually how we're approaching it. So we're leaning into it. I don't see it as a disruption. That's been our stated strategy. This is where our multi-rail philosophy and strategy, as well as our ability to provide choice across various rails, one of which will be an open banking rail used for payment services. It's very helpful because it helps open up the total addressable market, which is available to us from what used to be primarily car focused to much more than car focused. And we do see that opportunity come through here in open banking as well." Personally, I believe it will be very hard for open banking and account-to-account payments to disrupt MasterCard's payment network because of the network effect I talked about earlier. Let's talk about MasterCard stock valuation. I always use this intrinsic value calculator to calculate the stock's fair interest value, so I would know whether the stock is overvalued, fairly valued, or undervalued. If you want this intrinsic value calculator, you can download it in my Patreon blog in the video description. Here are the key assumptions. First, I define MasterCard's intrinsic value as its future cash flows discounted to the present day. The discount rate is 8%. This is slightly higher than the 7.3% cost of equity calculated by Finbox.com. You can use a higher discount rate here if you want to be more conservative. MasterCard's most recent 12 months of free cash flow is $7.79 billion. Based on the growth catalyst I talked about earlier, I believe MasterCard's free cash flow will grow at a compound annual growth rate CAGR between 15% and 25% over the next 5 years. To calculate the terminal value at the end of year 5, we're using both the perpetual growth model and the exit multiple model here. Then we take the average of both models to calculate the terminal value. Let's go over these 3 case scenarios: the worst case, the normal case, and the best case scenarios. Under the worst case scenario, we're using a compound annual growth rate CAGR of 15%. If we forecast MasterCard's free cash flow to the next 5 years and discount the free cash flow to the present day, MasterCard's intrinsic value should be around $268 billion for the entire company, or $273 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're using a compound annual growth rate CAGR of 20%. If we forecast MasterCard's free cash flow to the next 5 years and discount the free cash flow to the present day, MasterCard's intrinsic value should be around $327 billion for the entire company, or $333 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're using a compound annual growth rate CAGR of 25%. If we forecast MasterCard's free cash flow to the next 5 years and discount the free cash flow to the present day, MasterCard's intrinsic value should be around $397 billion for the entire company, or $404 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, MasterCard's fair intrinsic value should be around $336 per share at the time of making this video. Now, just to compare, Morningstar estimated MasterCard's fair value to be around $352 per share. This means MasterCard stock, in my opinion, is undervalued at the time of making this video. So will I buy MasterCard stock? Yes, I will buy more MasterCard stock going forward because I like MasterCard's payment network business, which is essentially a duopoly with Visa. MasterCard is innovating in many new businesses, including buy now, pay later, crypto-linked payment cards, open banking, and other payment services such as account-to-account payments. I bought MasterCard shares recently because I believe MasterCard is undervalued. I have MasterCard in my portfolio for many years already. Based on my estimate, I believe MasterCard's fair interest value is around $336 per share. This means MasterCard is likely undervalued at the time of making this video. Now, all these estimates are only my opinions and my analysis based on my research. They are not financial advice. Make sure you always do your research and do your extra due diligence first before investing in anything. Do not invest in anything you do not understand. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos a week that will help you become a great investor. The link is in the video description. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.